Good morning or afternoon, depending on where you're joining us from. Thank you very much for joining us, and a warm welcome to this Fastmarkets webinar. Over the next hour or so, we're going to provide you with our outlook on the market for battery raw materials. I'm Paul Lusty, and I look after the Fastmarkets battery raw materials research area. This team at Fastmarkets produces both our short and also our long-term forecasts, and also our related new generation energy products. We've got an expanding global team of now around 20 analysts that provide market analysis, forecasts, cost assessment, and client consultancy around the battery raw materials. This team of analysts are complemented by around 20 price reporters within Fastmarkets and a number of events specialists. All the slides from today's webinar and also a recording of the event will be available to everyone who's registered. So this is the agenda for today's webinar. As the world transitions towards a net zero economy, demand for raw materials is going to grow hugely. And this is particularly the case for those used in batteries. We're going to see a surge in demand over the next decade, and this is going to place huge pressure on supply chains. Over the past couple of years, looking back, the battery raw materials market has resembled something of a roller coaster ride. And this has been characterized by significant price volatility. So today we've got 7 of our analysts and also one of our editorial team joining us. The analysts are going to talk to you about the key market dynamics at play and also our forecast supply-demand balances and prices. So to kick off, we're going to start with our battery raw materials demand outlook. We'll then move to our lithium, cobalt, and also nickel market outlooks. We're also going to have a brief mention of our recent Fastmarkets price launches. We'll then provide our outlooks for graphite and also the manganese sulfate market. We'll also be presenting our battery cell cost modeling work and also our recycling and black mass outlooks. We'll finally end the webinar with at least 10 minutes of questions. So please do post any questions that you have for the analysts in the chat, and we'll attempt to work through as many of those as possible towards the end of the webinar. I'm now going to hand over to Phoebe, who's going to give our outlook on battery raw materials demand.
Thank you, Paul. Yeah, so I'm going. Sorry, 2 seconds. So I'm going to be chatting today about battery demand. We're going to be looking at the full scope of the market, starting with a bit of macro and then working down into some 2 key factors that we're looking at today. Next slide, please, Paul. So if we look at having some technical difficulties, 2 seconds. So yes, just to kick off, sorry about that, everyone. We're back in the room, ready to go. So the graph on the left-hand side is showcasing what we're forecasting for battery raw material demand over the decade. we're expecting it to grow fourfold over the decade. And if we look out to 2033, just to put some numbers on that, we're looking at 4 million tons of graphite, 3.6 million tons of lithium, 2 million tons of nickel, 550,000 tons of manganese, and 400,000 tons of cobalt. Now, that's all fair and well, but obviously the key question there is, where is that demand coming from? Next, please. And we can see on the graph on the right-hand side that unsurprisingly, EVs are going to take the largest market share, reaching 81% by 2033. Fast behind them, however, is energy storage systems, which I'll come on to later in my presentation, taking 15%. Another industry is consumer electronics, which we expect to remain fairly flat, taking 4%. And then a new category we've introduced is called battery swaps. This is a way of charging your vehicle that's an alternative to charging points. You literally swap the battery from under the car or the vehicle and replace it with a newly charged version. And we expect that industry to take 2%, and it's fastly evolving in regions such as Asia. Next, please. Now, if we just have a bit of a deep dive into EVs, just to really understand where the demand's coming from there, we can see in the graph on the left-hand side, again, slightly unsurprisingly, passenger battery EVs is taking the largest market share for battery demand over the decade. However, what I think is most interesting here is if we look out to 2033, we can see a diversification of colors, and that's a result of the greening and the electrification of fleets that we're expecting in e-buses and e-trucks, which both share a CAGR of 20%, showing strong growth there over the decade. And then a key question obviously is, that's all fair and well, but where is that EV battery demand coming from by region? And what we can see in the graph on the right-hand side, kind of two key takeaways there. If we look at 2033, we can see that China remains the key market for battery demand, holding 38%. However, what I would highlight here is that that is a downgrade from 53% this year. And what that shows is a growth towards regionalization and localization, which is forcing different industry actors to move their supply chains away from China and growing battery demand in those locations. We can also see that in the second key factor if we look at other markets like India, South Korea, and Japan, which we're expecting to take 4%, 3%, and 2% of the market in 2033. Those markets are fast evolving given their nascency, and we're seeing really strong growth rates there given the investments into battery supply chains. Next slide, please. And now one key market that we wanted to highlight, which is growing the fastest out of all the industries, is energy storage systems. And now just to take a bit of a step back to get everyone on the same page about what we mean when we say energy storage systems, this is essentially where we use batteries or other technology items to harness electricity off the grid and then utilize that energy at another point in time. So the graphic on the left-hand side is just showcasing some of the ways in which batteries are being used to harness and then expend that energy either on the grid or before the meter or residentially and commercially behind the meter. And we're going to see this grow as more renewable energy comes onto the grid due to the frequency changes and the kind of difference in power generation that renewable energy provides. Next, please. Yeah, so what we can see on the right-hand side is our energy storage system demand forecast. We're expecting that, again, there's going to be huge growth in this industry as a result of massive battery demand. And it doubled last year. We're expecting it to reach over 800 gigawatt hours in 2033. And the key markets to look out for there are China and the US. Another thing to highlight with this graph is our chemistry forecast for energy storage systems. We're expecting LFP to remain the dominant chemistry as a result of its cost and the affordability and the trustworthiness that a lot of developers have in this chemistry. Next, please. And this links on really well to my next slide, which is looking at two of our key factors that we've been analyzing in the battery market over the last year. The first here is our chemistry outlook. Why is this important? Because we need to understand chemistries in order to understand what metals are going to be demanded by the battery industry. And here we can see a graph looking at chemistry demand across three key industries: EVs, energy storage systems, and consumer electronics. And the three key takeaways here are, number one, LFP is going to be the dominant chemistry across these industries, taking 48% of the market. And this is mainly due to OEMs and ESS manufacturers increasing their use of this cost-effective chemistry. The second is that NCM is close behind. NCM will actually be the dominant chemistry in the EV segment by itself. And that's largely due to the rise of high nickel NCM, which is increasing in popularity. The last one to highlight is sodium ion. It's been all over everyone's news feeds. And our view on this chemistry is that it's going to take a very small margin of market share. Cost analysis by our in-house team and also other firms have highlighted that actually on cost bases, sodium ion and LFP are not actually that dissimilar. In fact, in many cases, because of sodium ion's hard carbon anode, it's actually more expensive. So we're only expecting it to take 2% of battery demand by 2033. Next slide, please. And a final trend to highlight is overcapacity and overdevelopment of battery manufacturing in China. The graph on the left-hand side is showcasing what we found in battery development in China. There was a production of 99 gigawatt hours of excess in last year alone. And if we look at the graph on the right-hand side, what we can see is that this overcapacity is playing out month by month in installation and production rates in China. And we can see that in the graph with LFP production reaching a massive 21 gigawatt hours of excess in July of this year. Now, why is this important? It's going to be really difficult for battery producers who are newly coming to market in North America and Europe to keep up with this level of cell manufacturing. And also, point two, the cost competitiveness of these manufacturers. If there's a huge amount of these cells coming to market in China, there's going to be massive pressure on cost. And as a result, it's going to be difficult for new manufacturers to keep pace. And with that, I'll hand over to my colleague Chandler, who's going to speak to some of these trends with the lithium market.
All right, thanks, Phoebe. I'm Chandler Wu. I will take care of the lithium markets in this webinar. And in my first slide, please. Next slide, please. Okay, yeah, actually that we have witnessed the destocking in the lithium market lasted for around 1 year in supply chain. And in Q4 of this year, we see the possibilities of the price staged rebound, mainly for three reasons. First is that the seasonal demand increased from the EV in the end of this year, and which will spread to the demand of LLC and LHR. And second is that price mechanism has adjusted the LCE equivalent supply growth rate from 60% year to date in this January to about 32% year to date growth as of September of this year in China to match the slowing demand. The third is that the production from the brine is likely to decrease due to the seasonality, due to the temperature. So all these might lead to the active restocking scenario if the demand picking up as expected. But we won't expect too much rebound like what has happened in this May, because that the inventory from the refinery is still high, and also that some JIT just-in-time approach is applied in the downstream players, which keep their inventory relatively low. Next slide, please. Yeah, and also that we the main topics of this year for the lithium is that supply demand reverse in 2023. This year we have 37 year-on-year increase in the lithium supply, and the incremental supply is feed by 29 year-on-year increase the primary feed, which is increasing volumes from the Australia, from China, from South America, coupled with some OPEC volume from Africa like Nigeria. And also that 44% year-on-year increase the secondary feed, and as well as destocking. On the other side of the coin, we turn into the demand side, we saw lower increase rate comparing to the supply side, which is only 30% year-on-year growth. So within that, for sure, 46 year-on-year in batteries still is strongest engine for the lithium demand. Both caused the price crash by 71% in 2023 from the top of 2022 as of this October. Next slide, please. Next slide, please. Yeah. So to sum up, overall, we saw the large surplus in 2023, but after destocking space, after we taking the destocking space into the consideration, we think that the surplus will ease in 2024 comparing with 2023 and turned into deficit again in 2025. But there's also always the possibilities of the supply expansion risk as we saw some of it in 2023. And as there will be a process of the widening of the cost curve, including the DRE, which is double the recovery, then the more normal process and the lower cost miners or processors, which will sit in the safe region of the cost curve in the next several years. So we think the price will continue to decrease in an annual basis and the volatility will remain. So this is from my side, and now I will hand it over to Rob, who will present about the coal market.
Thank you very much, Chandler. So yes, I'm Rob Searle, and if we move on to the next slide, I'm going to start on our cobalt market outlook. Sort of the headline piece being of the cobalt demand and pricing, which remains weak in the current macro environment that we're sitting in. So charted here, we're looking at the standard grade cobalt metal price as well as the cobalt hydroxide payable. But of course, this low price dynamic has continued across the whole cobalt value chain, with cobalt sulfate and cobalt tetroxide remaining low through 2023 as well. So upstream, we've seen strong mine supply growth and the buildup of inventories of cobalt hydroxide in the DRC. And this has continued to pressure the hydroxide payable through the year. We're expecting further expansions and ramp-ups in the coming 12 months to continue to weigh on the hydroxide payable. Now, downstream, demand has been mixed, but broadly weak. We see that in the lithium-ion battery sector, this has struggled with weak consumer spending and high interest rates, and this has pressured the NCM CAM market as well as the consumer electronics market. Superalloy demand has been a bright spot through the year, particularly in the US and China. We've seen applications such as aerospace, military, and medical seeing close to double-digit growth or even higher, but this remains a minority share of the total cobalt end uses, and as such, prices have remained low. As we're heading through Q4 and towards the end of the year, the metal market has seen somewhat of a rally, and we do expect prices to kind of fluctuate, but remain where they similar levels as we move towards the end of the year. But we think that with the upstream mined capacity additions, as well as lengthening metal supply on refined capacity additions in China, this is probably going to have plentiful supply heading into 2024 and keep a lid on any major price rises. So if we move on to the next slide, we can see what this looks like when we build it into our kind of short to mid-term market view. Now, we're expecting in the short term a surplus to remain in the cobalt market, but are still bullish on the long-term demand outlook of cobalt. The weak pricing dynamics is expected to last into 2024 on the surplus that we expect to see in the market next year. Now, this is on the back of, as we said, expansions this year in the DRC and Indonesia, the fastest growing cobalt supply base, which we expect to continue into 2024, combined with these refined capacity additions in China. Now, these refined capacity additions are expected to lead to a greater volume of metal exported into the seaborne market once the material has been qualified, and this will continue to pressure the standard grade metal price in the early stages of 2024. There are risks, of course, to this view of a surplus next year, and we expect to potentially see some cutbacks and further delays to certain projects, but for now, we are still confident of the market being well supplied into next year. Post-2024, we believe the scale of capacity additions is forecast to slow, and with production expected to adjust, we believe that recovering demand in next year and into 2025 will see this market surplus shrink. Our cobalt demand forecast is supported by a very bullish EV forecast. NCM is still forecast to hold the market share for the EV market, And we believe total cobalt demand will see a CAGR of 9% from 2022 through to 2033. Now, on the next slide, obviously, we've talked a lot about the capacity expansions or mine expansions in the DRC and in Indonesia, as well as the refined base in China. But since our last webinar, there's been more announcements and more talk about the US and the North American market, which is beginning to mobilize. So investment is required in the US to ensure that OEMs and new energy vehicles continue to qualify for credits under the IRA. And there's also a major focus on securing domestic supply of strategic metals like cobalt for military and also aerospace. Here we're highlighting some of the projects such as Jervois, which have kind of pivoted towards a US-based refinery, Electra in Canada, which is making good progress on cobalt refinery, but also recent announcements such as Evolution Energy with an offtake agreement, Westwind Elements beginning pilot plant construction, and also Sunrise Energy Metals, an Australian miner which are considering pivoting to a US refinery as well. Now, currently government support is key for these projects, and the US Department of Defense is going quite a far way to fund some of them, such as Jervois, and this is paramount to advance these greenfield sites, particularly given the current climate we find ourselves in, where high interest rates and inflationary pressure continue to push costs up and are threatening the near-term development. And we continue to track these projects within our long-term forecast. I will now hand over to Olivier.
Thank you, Rob. My name is Olivier Masson, and I will take you through the near-term outlook for nickel. The first slide shows that the stainless steel industry remains by far the largest consumer of primary nickel. Crude stainless steel production will grow at a CAGR of 3.2% between 2022 and 2027. This growth will be led by China, which is important since the country is by far the largest producer of stainless steel in the world, and the industry is also heavily reliant on nickel from primary sources rather than from scrap. High nickel requirements by the Chinese stainless steel industry will need to be mostly met by greater production of primary nickel. On top of this, 60% of the volume growth will be high nickel 300 series, and 31% of the volume growth will be low nickel containing 200 series. Turning to the next slide, total consumption will rise at a CAGR of 6.4% between end 2022 and 2027. 1/3 of this demand growth will come from the stainless steel industry, and given the outlook for electric vehicles and energy storage systems given by Phoebe earlier, 56% of the volume growth of demand will come from the battery industry. This means that the stainless steel industry's share of primary nickel demand will continue to fall, declining to 59% in 2027, having peaked at 72% in 2020. The battery industry's share of consumption will rise to 23% of demand by 2027, up from 6% in 2020. As a result, consumption of Class 2 material, which is essentially nickel pig iron and ferronickel, will decline to 53% of total demand in 2027 from 62% in 2022, even though usage will increase by over 330 kilotons of nickel over this period. Most of the growth in demand will be for nickel sulfate. Demand growth here will increase by nearly 600 kilotons of contained nickel over the same period, mostly driven by growth in demand from the battery industry. Turning to the next slide. Where will the nickel come from? Well, here all roads lead to Indonesia. Primary nickel production will grow at a CAGR of 8.6% between ends 2022 and 2027 before we apply provisions for production disruptions. Over the same period, Indonesian supply will rise by an average of 11.6% per year. Mine supply in the country has surged in recent years in order to feed a massive expansion in domestic refining capacity. Initially, this was to produce NPI for the Chinese and domestic stainless steel industries. But with the growth in the battery sector, additional investments in new capacity are being made, and this new capacity will produce nickel intermediates, which will be refined into nickel sulfate in both Indonesia and in China. Chinese primary production will rise at a CAGR of 7.6% between 2022 and 2027. So on the next slide, so rapid has been the rise in Class 2 production that the Indonesian authorities are seeking to slow the growth in production of such material. As a result, production of Class 2 will rise at a CAGR of only 4% in the next 5 years. Most of the growth in production will be from nickel sulfate, which will account for over half of total production volume growth. Also of note, Chinese producers are investing in new Class 1 capacity, although we expect production of Class 1 to lag growth in sulfate and Class 2 supply. So turning to the next slide, putting this all together, given the strong growth in principally Indonesian production, we expect the nickel market to remain oversupplied in the next 5 years. Most of this oversupply will be Class 2 material, however, and because of this, we expect the decline in the LME cash price, which is for Class 1 material, to be relatively modest over the next 5 years. So I thank you for your attention, and I will now hand you over to my colleague Justin Yang, who will take you through some exciting developments to Fastmarkets' nickel price offering.
Great. Thank you very much, Olivier. My name is Justin Yang. I'm Strategic Markets Editor, focusing on energy transition here at Fastmarkets. What I do is a little bit different from everyone in this presentation. I look after the day-to-day pricing, which means I focus on today and not as much as tomorrow as my colleagues here. So I'm here to take a few minutes of your time to talk a little bit about some new developments on our nickel price. We had 2 new nickel daily prices on a FOB Indonesia basis launched on October 27th. And like Olivier said, all roads lead to Indonesia when it comes to nickel. It is it is the global nickel hub for stainless steel production and battery usages. And as a result, we feel like there's the need to add more transparency to the market there on a FOB Indonesia basis. So these prices represent some of the first FOB Indonesia price assessments for nickel, and they complement our existing price offering in nickel, which encompasses sulfate, refined premiums, ferronickel. So it already adds to a large portfolio of nickel prices that we have already. And the decision to launch this is because we want to provide the industry with more choice over reference prices for more nickel products. It also allows Fastmarkets to provide more transparency on this side of the world. So next slide, please. So here are the specifications for the 2 new daily prices. As you can see, it publishes at 4 p.m. London time on a daily basis. So it will track any sort of fluctuations in the market. And if you have any questions, please feel free to reach out in the Q&A or email me directly. Thank you very much for your time. And I'll pass that on to Amy for an update on graphite next. Thank you.
Great, thank you, Justin. So I will be taking you through our graphite market outlook. Frankly, graphite over the past year has been a pretty dull and depressing market. However, that all changed about last month when China announced the imposition of temporary export controls on graphite starting December 1st. So there are several implications of this news for the market, and we think there's several reasons behind China's decision to do this. We think the timing is partially due to the fact that it has been such a difficult year for graphite, really characterized by falling prices and oversupply. And this move could be, in part, an attempt to help boost some of the activity in that market. Secondly, of course, I think, and as this slide quite rightly demonstrates, China is also sending a reminder to the rest of the world of their dominance in graphite, and therefore the rest of the world's dependency on Chinese graphite, particularly in the battery sector. So here, if we're looking at on the natural graphite side of the market, the key things to note here are China's dominance with probably over 99% of natural graphite precursor material, the uncoated spherical purified graphite. That product is almost entirely made in China, except for a few pilot projects around the world. Of that material, most of it is converted to the final active anode material product within China, but about 10% is exported to countries including South Korea, Japan, and to a lesser extent, the US and some European countries as well. So there we see China has about a 90% share of the natural graphite active anode material product. Turning to synthetic graphite, that's where China has really made even more moves over the past year. We've seen an incredible increase in Chinese graphitization capacity over the past year, and that has been really reflected in not only kind of a flooding of the market, in large part responsible for many of the price declines we've seen recently, but also really increasing China's dominance in this space, with China holding about 95% of the market for synthetic graphite active anode material. Putting those two sides of the market together between natural and synthetic graphite, China's overall graphite active anode material market share is about 93% of global production. So clearly this is very much a China-centered market. And while the rest of the world is clearly looking to increase their space in this market, these falling graphite prices that we've been seeing are absolutely hindering investment and are not conducive to investing in this space. With prices on the spherical graphite side, an 11-year low in the third quarter of this year, and they fell to that level and have remained there at these lows of around $2,000 to $2,200 per ton. This is at or below production costs, even for the Chinese producers. So really, with this supply available in ample quantities, there's very little incentive for producers around the rest of the world to invest in these projects. Flake prices, the natural graphite flake, which is really the raw material product for this natural graphite spherical product, those prices have also been tumbling. We've seen slow demand not only from the battery sector, but also from the steel sector. And we've seen production cuts in response from both Chinese and African producers in particular. Oh, sorry. Can we go back one slide, please? Thanks. So essentially what we're looking at now is between the news of these export controls coming, as well as normal seasonal production outages, particularly in China, we do believe that a pricing floor is imminent, and we do expect to see prices bottoming out and showing some modest improvement as we head into next year. And on the next slide, I'll go through a bit of our outlook for graphite over the next several years. I think a key point is that Chinese supply of battery-grade graphite is sufficient to meet global demand. However, there is a huge incentive at the moment around the world by governments to ensure that there is localized, diversified supply of graphite and other key battery raw materials. We've seen investment, certainly very much on the lithium and the cathode material side of the market, but the anode has largely been ignored or looked over quite a bit. And we think that's largely because the anode has only comprised about 10% of the total battery cost, but it does account for 50% of the weight. So this is a really critical side of the market, and we do need to see some higher prices to encourage this ex-China supply, because without higher prices, China will continue to dominate this market, and that will cause some real problems in terms of these incentives to get this localized, diversified supply. So really what we're seeing, and we expect to see, is that while in the next several years, China will continue to dominate the supply and the market will be adequately supplied, as we move out beyond 2025, we do expect to see some shortfalls reemerge. And this is where there's definitely an opportunity for some premium pricing to develop to encourage this ex-China supply to support this ESG-friendly supply as well. And now I will pass over to Rob, who will take us through manganese.
Thank you very much, Amy. So yeah, we're going to talk now a little bit about our manganese sulfate forecast, one of the newer products. And I think the first slide here, we're just going to touch on a little bit of like the global or geographical breakdown of the high purity manganese sulfate market. And currently the Chinese control that we see, so very similar to graphite here, which we just talked about, this Chinese control of the manganese sulfate market does pose a threat to global CAM and battery producers. So currently, we see obviously China being the major supplier, and around 89% of the global total in 2022 came out of China. There are two producers outside of China, one in Belgium and one in Japan, but both of these are at a much smaller scale. We believe we have seen new capacity in Indonesia come online in 2023, and there's further ex-China capacity coming on from the middle of the decade. But from the chart here, we can see that we expect this investment and these capacity additions outside of China to be dwarfed by the current Chinese supply base, which can ramp up, and the expected additions. Of the regions we're tracking for high purity manganese sulfate supply, the Americas is expected to see the largest growth over the forecast period. This is with projects in the US, in Canada, and in Mexico, but it is still expected to remain significantly smaller than the Chinese base. And it's our view that this can potentially pose a threat to OEMs, particularly in the US and Europe, when adhering to sourcing regulations, which are going to come into play. So if we move on to the next slide, we can then see how this fits in with our demand outlook. Now, high purity manganese sulfate demand is forecast to outstrip supply by 2028. And for now, we're expecting the market to be fairly balanced out past the middle of the decade. Now, the reason for this is, as we said, in China currently, the large installed capacity and also the current low operating rates mean that we're confident the market will be able to ramp up as and when NCM demand recovers in 2024 and into 2025. When we look in 2023, we've forecast a slightly smaller surplus than in 2022 and much smaller than in 2021. This is as a result of cutbacks, which we have heard of at certain Chinese processors. The reasons behind these cutbacks are the large oversupply and stock buildup, which we talked about, the weaker than expected NCM battery demand through 2023 so far, and prices on the Chinese high purity manganese sulfate, which have fallen to close to the cost of production and have led to some cutbacks there. From the middle of the decade, as we say, from 2025, we're expecting the next round of ex-China refining capacity to come online in the US, followed by units in Africa, Canada, and Europe in 2026 and 2027. But it's our view that the demand growth in the NCM market, as well as from new high manganese NCM cathode technologies from the middle of the decade, will outstrip the supply additions and lead to a structural deficit heading into the second half of the decade. Now, similar with graphite, we touched upon on the first slide the threat around OEMs or battery producers not being able to adhere to sourcing regulations. If we were to see similar export restrictions as we've heard of in graphite, this again could cause significant issues in the short term, given the Chinese control of the high purity manganese sulfate base. And this is why there is a need for this ex-China refined capacity to come online successfully. Now, on third and the last slide here, we're going to talk a little bit now on sort of our view of a demand forecast and potentially the upside or a larger growth in demand. Now, high purity manganese demand could significantly outstrip the current industry forecast, with high manganese loading chemistries entering the market at a fast rate. Now, we're focusing here on high purity manganese rather than just manganese sulfate, because this feed could be coming from a large number of different manganese chemicals or salts, such as carbonate, oxide, dioxide, or just high purity electrolytic manganese metal. At Fastmarkets, our view in the yellow box there can almost be seen as a sort of low case demand outlook. And as we move through this decade, the development of high manganese chemistries, such as lithium manganese rich, LMFP, or LMNO, could significantly increase the demand growth into the 2030s. The favorable ESG profile, the lack of upstream bottlenecks on mine supply of manganese, and the current low prices is leading PCAM, CAM, and battery producers around the globe to explore the possibility of manganese displacing nickel and cobalt values further. And these new manganese-rich cathode technologies could contain close to 3 times the manganese content compared to the current NCM base. We've modeled this out, and our basic view is that potentially we could see a 67% increase in the high purity manganese demand by the end of the outlook. And this would significantly tighten the manganese market for battery grade material and lead to a structural deficit earlier than previously forecast. Now I'm going to pass on to Krishna to talk about our cell costs and forecasting.
Okay, thank you very much, Rob. I'll now talk you all through our modeled should cost estimates for cell and pack cost, past, present, and future, using the Fastmarkets Battery Cost Index. Presented on my first slide is the average cell cost in China in dollars per kilowatt hour for different CAM chemistries across all formats from January of last year to this year, September. Costs have now dropped 40% since peaking in March of 2022. NCM is now around $85 per kilowatt hour, whilst LFP maintains its cost advantage at just under $80 per kilowatt hour. However, this is just a 4% difference compared to 11% in March. And this is mostly due to the price difference between lithium carbonate and hydroxide. NCM 811 requires hydroxide, whereas the other CAMs typically use carbonate. Let's look more closely at current pack costs on the next slide. Here we present modeled pack costs for NCM 811 versus LFP in China, South Korea, Germany, and the USA for September. Let's start with NCM 811 on the left over here. Purple at the bottom, that's the CAM cost, which makes up around 40% of total NCM pack cost. Then anode in blue, separator, electrolyte, other cell materials, followed by gigafactory, energy, labor, and operational costs in orange. Everything below this point is cell cost. Finally, the gray at the very top is an estimate for pack cost, materials, and assembly. Costs are higher in the West at around $135 to $139 per kilowatt hour, where manufacturing costs are greater. However, if the full 45X IRA tax credit is applied, this brings the US pack cost down to $94 per kilowatt hour, well below that of China. For LFP on the right, we see similarities, but there are some interesting findings. For example, LFP has a lower energy density than NCM 811, meaning more cells must be produced per unit gigawatt hour. In countries with higher manufacturing costs, such as Germany and the USA, this actually makes LFP more expensive than NCM 811 on the cell level. But LFP is more thermally stable, so pack design can be simplified and made less complex. So on the pack level, LFP is currently 5% less expensive than NCM 811 on average. Now, caveats. This model assumes a 1 gigawatt hour per year production and assumes that the plants are already mature, which we know is not the case in the West. Ramping up comes with significant yield losses, which will drive costs up. But this analysis shows how things could look in future. Let's now look more into the future on the next slide. The battery pack cost forecast in dollars per kilowatt hour for 4 different cell chemistries are presented here. NCM 811 in purple, 955, next generation NCM in purple dashed, LFP in orange, and LMFP in orange dashed. This is the base case from our long-term forecast analysis. These values are global weighted averages and do not consider the IRA tax credit or solid state. The black line is the $100 per kilowatt hour pack target that will enable EV price parity with ICE vehicles. Today's NCM 811 technology is unlikely to reach this target. On the cell level, NCM 955 will reach around 320 watt-hours per kilogram energy density, making it 19% cheaper than current 811 cells. Likewise, LMFP will reach around 215 watt-hours per kilogram, enabling it to become 14% cheaper than today's LFP cells. Overall, NCM 955, we expect it to beat 811 and LFP on cost, but LMFP comes out as cheapest overall on both cell and pack level. Both next-gen chemistries come with engineering challenges, but offer significant cost savings. Also, note that LFP is the only mature chemistry that will reach $100 per kilowatt hour in the near future, likely as early as next year. Finally, by 2030, we expect pack costs to get down as low as $78 to $86 per kilowatt hour. So in summary, you can see how important increasing energy density, relying more on LFP, LMFP, and government incentives are to reducing passenger BEV cost. However, to really drive down EV prices, pack sizes must also reduce. More focus is needed on smaller, faster charging BEV packs, less than 60 kilowatt hours in size, whilst improvements are made to the charging infrastructure. And just to note, a 15% reduction in average pack size outside China over the next 10 years would substantially reduce EV cost whilst also saving 1 million tons of LCE. And that's enough for 14 million BEVs powered by 50 kilowatt-hour LFP packs. So I hope you found this useful and thank you for your time. I'll now pass on to Julia to talk about recycling and black mass.
Thanks very much, Krishna. My first slide, I'm going to be talking about scrap batteries. So as you can see, scrap batteries come from two sources. The purple on the graph is production scrap, so that's coming from gigafactories, and the blue is end-of-life batteries. So as you can see, in 2023, we expect about 80% of all of the batteries to be coming from production scrap. And in total, we expect 1 million tons of scrap in 2023, increasing to 2 million tons by 2027. And since black mass has a yield of about 50%, because you're removing the plastics, electrolyte, aluminium, and copper foils, that gives us 500,000 tons of black mass in 2023 and 1 million tons of black mass in 2027. On my next slide, I'm going to be talking about payables. So Fastmarkets have black mass payables for NCM and LCO for South Korea, Southeast Asia, and Europe. So this one is our NCM NCA South Korean payable. It's our most liquid payable. And you can see the black mass metal range for that NCM NCA black mass. So of course, no two batches of black mass are the same, but the beauty of the payable method is that you can apply it to any given black mass with a particular metal content. As you can see on the graph, the nickel and cobalt payable has ranged from about 60 to 80. Averaging 70, and the lithium payable has been consistently 4.5%. The underlying prices we chose to use are the benchmark prices, so that's LME nickel, Fastmarkets cobalt, and Fastmarkets lithium carbonate. On my next slide, I'm going to be talking about the inferred price that gives us. So if we take the midpoint of those metal ranges, then you can see the, and also the given underlying price on a specific date, then you can see the inferred price. So I think one of the most interesting things about this graph is you can see in purple and yellow, there's South Korea and Southeast Asia, and then in blue, there's Europe. So there's a big difference between those two prices. So why is the Asian price about 20% higher than Europe? Well, first of all, there are higher recovery rates in Asia. So they're better able to get a little bit more nickel, cobalt, lithium out of the same batch of black mass, so they can get more value from it. Also, we're seeing in Europe and America, battery shredders who are producing black mass are coming online very quickly because it has low capex and it's relatively easy to get online. But in terms of refining for Europe and America, there are a lot more hurdles to jump through, and we're seeing a lot of delays to those projects. So it means that there's a surplus of black mass in Europe and America. And because it can be hard to store, it's often regarded as a hazardous waste. So it's hard to store for more than 6 months. It's being exported to Asia, particularly Southeast Asia and South Korea. The reason it's going to, well, one of the reasons it's going to Southeast Asia is because there is an import ban of black mass in China. So it often goes to Indonesia to be converted to MHP, and then it can be imported into China. And also Europe has some challenges with black mass. From next June, it will officially be a hazardous waste, which means it will only be able to be exported to OECD countries. And there are still quite a few hurdles to get through. I'd now like to hand back over to Paul to wrap up.
Many thanks to all of the team that have presented today. So just to conclude, these are our sort of key takeaways from the outlook today. On energy storage front, in terms of demand, this is going to be the key growth sector for the battery raw materials demand in the near term. In terms of headwinds, there are concerns about the rate that China has built out its domestic manufacturing capacity. Its supply is going to significantly overshoot domestic demand. In terms of lithium, we certainly expect prices to remain around current levels in the short term. but with significant volatility persisting in the market. As Rob talked about, the expansions both on the mining and the refining side mean that price rises across cobalt raw materials are going to be limited in the near term. Looking over towards nickel and what Olivia talked about, despite that very strong growth that we see from both batteries and stainless steel, it is our view that the market will remain oversupplied for several years and prices will remain subdued. Moving on to graphite, which Amy gave the outlook for, Chinese export controls which are going to be coming into force in December, are obviously the highlights of the last couple of months, but we do believe these will promote higher prices, and also that increase in prices that are likely to encourage development of projects outside China. Looking to manganese sulfate, China will remain the major supplier over the next decade, although we are seeing significant capacity development in some other regions. When we think about cell costs and the work that Krishna presented on our battery cost index, it's very much our view that the auto industry outside China needs to be looking to LFP and LMFP and potentially smaller pack sizes to reduce vehicle costs and promote adoption. And finally, just to wrap up in terms of what Julia said, recycling is going to increase in terms of its importance from currently a very small supply base, but this distinct difference in maturity and capacity between the Asian and European markets really results in the significant price differential that we currently see. So before we dive into the Q&A, I just wanted to highlight some of the products that are available from Fastmarkets and which the analysts team here feed into. So from our dashboard, you can access all our Fastmarket prices and price assessments. We also have what we term a weekly tracker product, which provides our short-term forecast for all of the battery raw materials, but also an outlook for the black mass and recycling market with a commentary of developments that have taken place in the last week. Our long-term forecast products present a much deeper dive into the markets, and we provide for long-term forecast products for all of the battery raw materials that you've heard about today, but also copper, along with project or asset level cost analysis within those products. At Fastmarkets, we've got a dedicated events team who produce a range of conferences across the markets that we cover. In terms of the battery raw materials, our forthcoming events are in December, so next month in Shanghai. Then we're moving to Seoul in April for our Asian battery raw materials conference. And then in June, we return to Las Vegas for our lithium and battery raw materials conference in North America. We also offer a range of bespoke consultancy services to provide analysis and insights into these markets. So I'm now going to very swiftly dive into our Q&A for the final few minutes of the webinar. Just having a quick flick through the questions, and I probably will push this one over to Amy Bennett, who presented on graphite. We've got a question in the chat. How do we see the split between natural graphite and synthetic graphite in anodes evolving? And the second part of this question is, will natural graphite increase in share relative to synthetic graphite? So Amy, maybe you could pick that one up, please.
Yeah, absolutely. Thanks, Paul. And this is an excellent question, and one that's certainly a very hot topic. We definitely see this relationship evolving between natural and synthetic graphite in anodes. Over the past year or so, we've seen a significant increase in the synthetic graphite share versus natural, particularly because, as I mentioned earlier, of a massive increase in graphitization capacity within China over the past year. So really, at the moment, we're seeing the synthetic to natural ratio at about 85 to 90% synthetic, and just 10 to 15% natural. And that's really a function of this inexpensive synthetic graphite that's come to the market. Natural graphite, one of its key advantages versus synthetic was that it was a cheaper raw material. But at the moment, those synthetic graphite prices are on a par or lower than the natural graphite product. So that's caused a real shift in the market. Over the coming years, we do expect to see the natural graphite share rising again. However, I will say we do expect to see China remain very synthetic graphite heavy and much more dominant on that side, whereas we see more potential for natural graphite in the anode in the non-Chinese markets. I think that, as we do see more development in Europe and North America, we expect to see that more on the natural graphite anode side, and that's where we'll see a stronger split, probably back to, by 2033, more of a 50-50 split, largely due to increased use of natural graphite in anodes in the Western world. Certainly, there's also a question about, these non-graphite anode technologies such as silicon, lithium metal. There we see that silicon is probably the one to most likely take a growing share of this market over time. Again, we're thinking of that more as sort of a post-2030 situation. And even then, we don't see too much of the 100% silicon anodes, more of a split between the graphite and silicon in the anode, as much as maybe 10, 20, 30% silicon and the rest graphite.
I think, Amy, just following up on that and staying on the theme of graphite, what would be our expectations in terms of timeframes for potentially bringing on ex-China supply of graphite? I think this is very much tied to what you covered in your presentation with regards to us needing to see incentive prices in the market to really stimulate that investment outside of China.
Yeah, absolutely. I think that, we did see some higher graphite prices 2021, beginning of 2022, and that did help spur some of this investment. However, with prices collapsing now, in addition to various delays, still kind of so supply chain disruptions, we've had some delays to quite a few of the projects. The combination of these factors makes us think that this new kind of ex-China supply coming on is more likely to be sort of a 2026, 2027, 2028 type of scenario. There are significant lead times involved, not only with, if you're taking it to the mine level, getting that mine production up and running, but then there's, you have to build your processing plants, and then there's a qualification period for the anode, the active anode material, which can be, depending on your consumer, 1 to 3 years. So this investment needs to really happen as soon as possible to make sure that we have this ex-China graphite supply available later in the decade.
Okay, thank you, Amy. I'm just going to probably move to Krishna now. We've got a question on silicon anodes and what the potential they hold for the future. Christian, maybe you can come in and respond to that, please.
Yeah, sure. I was just have the answer. Yeah, so silicon anodes, I think there's great scope there. There's a lot of great work being done. However, there's announcements and then there's data. So from what I've seen, I haven't seen anything substantial beyond 20%. So silicon graphite mix with silicon content around 20%. That is kind of the extent of the technology at the moment. That's not to say in the future that can't get higher to 50 and maybe even more. But until we see, the performance data, the lifetime data, we're not considering it in our demand. I would also add that we're working on developing a cell cost calculator, where the user will be able to input their own cell design to calculate the cell cost at the end, and silicon content will be one of the components for the anode. So I hope that answers the question.
I'm probably now going to pass over and ask Phoebe to just maybe pick this one up on what our view is on CAM production in Europe. Will it be enough to support European gigafactories?
So in terms of, just to answer that question on CAM production in Europe, enough to support European gigafactories, we're seeing quite a rapid production rate of gigafactories in Europe. However, what we're not seeing is actually CAM producers coming to market to support that. That's mainly due to the fact that gigafactories are very easy to receive investment for and growing at a fast rate. CAM producers, the supply chain they have to establish is much more complex. So as a result, we're seeing most gigafactories in Europe secure their supply from CAM producers in China or in Asia. And that's a key risk and a key issue that the European Union and the Commission are facing. They're very aware of this. Their argument at Fastmarkets has always been that there needs to be a greater investment into CAM production, but also into refining of metals in the region, simply in order for the regionalization and localization to take place. However, we're yet to see that investment, particularly in lithium carbonate, if there's going to be this growth of LFP production. So for now, no, there isn't sufficient CAM production in Europe alone. It is growing, but not at the rate to support gigafactory output.
Okay, thank you, Phoebe. I'm now going to just pick up a couple of questions that are probably best answered by Julia, and these relate again, picking up on the European CAM theme. Do we have a view on the importance of recycling of materials in the production of EVs in Europe over the longer term? And then a sort of related question that we talked about in the webinar today is this 10 to 20% price difference between European and Asian black mass prices, and when we might expect to see convergence in those prices.
So in the first one, in my personal opinion, I think recycling is very important.
You're muted, Julia.
Can you hear me okay? I think it's very important as in terms of providing security of supply of battery metals. In my estimates, I think currently it's between 5 and 10% of all battery metal supply is coming from recycling, and in 10 years it'll be between 10 and 20%. But in that sense, it's going to play an important role. But equally, I think Second Life also will play an important role, and I think in some countries they will want to try and prolong the battery life for as long as possible. And in the other question, I think for the period of time where there are restrictions around exporting black mass from Europe, it's very hard to close that arbitrage opportunity. So we have high Asian prices, but not everyone in Europe is able to take advantage of that. At the moment, there are a few companies who are able to get local recognition that black mass in that local area is not regarded as hazardous waste, and so they can send it to a wider range of countries. But As I mentioned, from next June, there's going to be a stricter rule and it will be much harder. Well, you'll only be able to send it to OECD countries. So while those restrictions are in place, I think there will be a significant difference.
Thanks very much, Julia. I'm going to wrap up now with one final question. And I think, there's a lot of interest clearly in graphite currently. So I'm going to return back to Amy, just with regards to, can we give a very high level response in terms of the difference in CO2 footprint between natural graphite relative to synthetic graphite production?
Yeah, absolutely. This is something that we're looking at in our graphite long-term forecasts. Obviously, this is a really key, essential component of these markets. I would say that typically we see natural graphite having a lower CO2 footprint than synthetic graphite. There are, of course, exceptions to this rule, but particularly when we're looking at the Chinese setting, which is, of course, where most of this material is coming from at this point. The synthetic graphite production process is very environmentally unfriendly. It's a very high energy consuming footprint of synthetic versus natural. There are exceptions, of course. There are some areas where we are seeing development of synthetic graphite production where they have access to hydroelectric power and other more environmentally friendly, lower CO2 footprint areas. But overall, we do see natural graphite as having lower CO2 emissions than synthetic.
Amy. So we're approaching 10 minutes past the hour. So that very much brings us to the end of the webinar. Thank you very much for joining us today. If you've any further questions, you saw the contact details for myself and the analysts on the previous slide. If you'd like to know any more about any of the Fastmarkets products, which I quickly talked to us, please do reach out to us. We do hope that we will see many of you at our various conferences that I talked about over the next year. As I said right at the outset, everyone who's registered will receive a recording of the webinar, but also access to the slide deck. Thanks once again, and do enjoy the rest of your day.